Welcome to the deep dive. Today we're jumping into a really popular stock market strategy, swing trading.
Yeah, it's different from just buying and holding long term.
Right, and it's not that super fast-paced day trading either. It's about catching those price swings. Maybe over a few days, sometimes a few weeks.
Exactly. And we know you, our listeners, want to get the core ideas fast, get a good handle on it, but without, feeling totally overwhelmed.
So that's the plan today. We're digging into a practical guide to swing trading by Larry Swing.
He's got a specific approach we're going to unpack.
Yep. Our mission here is to pull out the essential concepts, the actual steps Larry Swing talks about in his guide.
So you can walk away feeling like you really get his method, what swing trading looks like from his perspective.
And maybe even think about how it could apply, potentially.
And for anyone who wants to go deeper after this, Larry Swing does provide his details. His website is mrsswing.com. That's mar-swing.com.
And there's an email too, larry@mrsswing.com.
Yeah, and he mentions the guide itself can be shared freely. Just need to keep the original notices on it.
Also, interesting point, the forewords have endorsements. Suri Dudella from Sixer.com and Sergey Permanov from Optionsmart.com.
Uh-huh. They both seem pretty positive about Larry Swing's system and his software, Swing Tracker, which we'll probably touch on later.
Definitely gives it some practical weight. Okay, so let's get started. What's the basic idea? What are swing traders, according to this guide, actually trying to do?
Well, at its heart, Larry Swing sees stock prices moving kind of like waves. They don't just shoot straight up or straight down.
Right, there's a rhythm to it.
Exactly. So in an uptrend, the general direction is up, but you get these little dips along the way. He calls those pullbacks.
Okay.
And in a downtrend, it's generally falling, but you see these brief bounces upward. Those are the pull-ups.
Let's try and picture that. Like an uptrend is like stairs going up. Each step, the high point, is higher than the last one.
And the flat bit, the low point before the next step up, is also higher than the previous low.
Yeah.
Higher highs and higher lows. That's the term he uses.
Got it. And downtrend is the reverse stairs going down, lower lows and lower highs.
Perfect. And the key idea for swing trading, based on this guide, is you want to trade with that main trend.
So if the stock's generally climbing,
You wait for one of those pullbacks, those little dips, and that's potentially your entry point to buy, thinking it'll head back up.
and if it's trending down,
Look for a pull-up, a little bounce, and consider selling short there, expecting it to resume the downtrend.
so it's really about capturing those shorter moves within the larger trend, not trying to call the absolute bottom or top.
Precisely. And Larry Swing points out some advantages compared to other ways of trading or investing.
Like what?
Well, he argues swing trading can potentially work in different market types. Bull markets, bear markets,
Yeah.
even the markets just kind of chopping sideways.
Okay, I can see that. Buy and hold relies on long-term growth, right? If the market's flat for ages, you're not seeing much happen.
Exactly. Your capital might just be sitting there. And then there's day trading. That's intense.
Well, yeah, glued to the screen all day.
Right. Swing trading aims for a balance. You're active, but maybe not that active. You're looking for trades over days or weeks, not minutes.
And he mentioned something about SEC rules potentially pushing day traders this way.
Yeah, the guide hints that some regulatory changes might have made swing trading a more feasible option for people who used to day trade.
Okay, this is where it gets really critical, I think. Discipline. Larry Swing talks a lot about his master plan. Why is that so central?
Well, his point is basically that we are often our own worst enemies in trading. Emotions.
Fear and greed.
Totally. Fear makes you sell winners too soon. Greed makes you hold losers too long, hoping they'll turn around. The master plan is designed as a set of mechanical rules.
To take the emotion out.
Exactly. It tells you when to get in, when to get out, based on objective stuff, not how you're feeling that day. He boils it down to 4 things: confidence in the plan, discipline to follow it, focus, and patience, waiting for the right setup.
Okay, that makes a lot of sense. So you've got the mindset, you've got the master plan framework. How do you actually find stocks that might be good candidates for a swing trade? What's the starting point?
The initial filter he suggests is looking at stocks priced at $7 a share or more.
Okay.
And they need decent trading activity, an average daily volume of at least 500,000 shares.
Why those numbers?
It's about liquidity, mostly. You want to be able to get in and out easily without your own trade massively moving the price.
Yeah.
And it avoids those really speculative penny stocks.
Right, which can be super volatile and maybe easier to manipulate.
Yeah. And later, he does mention he kind of prefers stocks above $12.
Yeah.
Finds patterns maybe easier to spot there.
Okay, so you have this pool of stocks meeting the price and volume criteria. What's the actual process then, step by step?
It's pretty logical. First, identify stocks that are clearly trending, up or down.
Got the trend. Then what?
Then, if it's an uptrend, you specifically look for one of those pullbacks we talked about, a temporary dip.
And downtrend, you look for the opposite, a pull up.
Exactly, a short rally. Once you see that counter-trend move happening within the main trend, you don't just guess. You use the master plan rules for your entry.
Like placing a specific type of order.
Yeah, typically a buy limit order for an uptrend pullback or a sell short limit order for a downtrend pull-up, waiting for a specific price trigger.
And risk management is built right in from the start, isn't it? Not an afterthought.
Absolutely critical. As soon as you enter, the plan says, put in your stop-loss order. That's your safety net if the trade goes wrong.
Limits your potential loss.
And you also place your profit target order. So if it goes your way, you lock in gains automatically at a certain level. He suggests using OCO orders. One cancels the other.
Ah, so if your profit target hits, the stop loss cancels, and vice versa. Clever.
Yeah, prevents accidental orders staying open. And managing that stop loss isn't a one-time thing either. You adjust it, usually daily, based on the master plan rules.
Okay, so finding these trends, these pullbacks, it sounds like it all comes down to looking at charts, right? Price history, volume.
That's right. It's technical analysis, using past behavior to try and gauge potential future moves.
Yeah.
But Larry Swing does stress you don't necessarily need to be like a super deep technical guru, especially with the tools available now.
Which brings us to the tools he offers or recommends through Mrs. Swing. What are they?
Okay, first up is his subscription service, Master Swings. It's basically a daily email,
What's in the email?
specific trade recommendations. It gives you the stock, the suggested entry price, a target price usually aiming for about 7% profit, and a stop loss level, targeting around a 4% max loss.
Very specific.
Yeah, and it includes a chart, key support and resistance levels, plus the 20-day and 50-day moving averages for context. He uses Lockheed Martin LMT as an example in the guide to show how it looks. Very actionable.
So that's like getting the fish delivered daily. What if you want to learn to fish yourself?
Well, then there's his Swing Tracker software. That's a real-time charting and scanning program.
Scanning.
Yeah, you can scan the whole market, or segments of it, for stocks that meet specific criteria you set. Price, volume, moving average setups, other indicators, even candlestick patterns.
So you can build scans based on his master plan ideas.
Exactly. You can save your scans, keep watch lists, set alerts, and importantly, it includes the specific patterns he uses for the Master Swing service built right in. It's more hands-on.
Okay. Any free options to get started?
There's Mrs. Swing Lite. That's a free weekly newsletter. It identifies potential long and short swing trades.
But you have to do more legwork.
Right. You then need to go check the charts yourself, get quotes from somewhere like Yahoo Finance or Stock Charts. He, of course, suggests Swing Tracker makes this easier.
Makes sense. And the last one was Swing Lab on the website.
Yeah, Swing Lab is a free area on MrSwing.com, and this is pretty interesting. It actually shows the formulas, the algebraic criteria he uses in his scans.
Like the actual code or logic?
Pretty much. It gives examples for four-swing long and short scans. They use things like moving averages, MAB20, SASM10, MATA20, closing price, close, highs and lows over recent days, like high GH1, a low W1, etc., to spot those 3-day pullbacks or rallies he looks for. Plus, indicators like force index and DMI.
Wow, so he shares the recipe.
Yeah, you can copy those formulas right into Swing Tracker if you have it and run the scans yourself. It's quite transparent about the methodology.
Definitely gives you a look under the hood. Okay, let's really dig into the master plan now. The actual rules for getting in and out, maybe focusing on a long trade first.
Okay, so the core risk-reward idea is aiming for that 7% profit target while capping your loss at around 4%.
And he has that strategy of selling half.
Right. When, or if, the stock hits that 7% gain from your entry, the plan says sell half your shares, lock in some profit.
Reduces your risk on the rest.
Exactly. And you let the other half run or ride the wave, as he puts it, hopefully for more gains, protected by a trailing stop loss.
Okay, what about the order types? You mentioned limit orders, stop orders.
Yeah. So for entering a long trade, it's usually a buy-stop order triggered when the price moves up to a certain level. To take that initial 7% profit, uses sell limit order, only sells at your target price or better.
And the safety net.
That's the stop loss order. Often a stop limit order, which becomes a limit order to sell if the price drops down to your stop level.
Now, timing the entry. He makes a big deal about gaps at the market open, right? Price opening significantly higher or lower than the previous close.
Yes, that's a key part of the entry rules. 3 scenarios. First, No significant gap, say. It opens within 50 cents of the last close.
What do you do then?
You wait just a few minutes after the market opens, then you can place your entry order.
Okay. Scenario 2. It gaps up by 50 cents or more.
Then you have to wait longer, at least 30 minutes after the open before you even consider entering. Let the initial frenzy maybe die down.
And the third, gapping down 50 cents or more.
Shorter wait about 5 minutes after the open. Again, probably just letting that initial gap-related volatility settle a bit.
Okay, so the waiting period depends on the gap. How about the price you actually use for your buy order trigger?
All right, if there was no gap, your trigger to buy is when the price trades just 6 cents. He uses 116th of a dollar in the guide above the high price from the previous day.
So you're buying as it breaks yesterday's high.
Essentially, yeah.
Yeah.
But if there was a gap, up or down, the trigger's different. It's 6 cents above the high of the current day's trading, but only after you've observed that waiting period, 30 minutes for a gap up, 5 minutes for a gap down.
Okay, that's specific. So your buy order hits, you're in the trade. What happens immediately next?
Instantly, you need to get those exit orders in place. The sell limit order for the 7% profit target on half your shares.
Got it.
And the stop loss order for your initial risk protection. The level for that initial stop is important. It's a higher of either 4% below your entry price or are 6 cents below the low of the day your entry was triggered on.
Why the higher of the two?
It provides a slightly tighter stop if the low of the entry day was relatively close to your entry price, giving a bit less wiggle room initially.
Okay. And that stop loss isn't static, right? You adjust it.
Correct. This is the trailing stop part. The day after you enter, you reassess. If there was no gap at the open that day, you look at the previous day's low price.
Yesterday's low.
Right. If 6 cents below that low is higher than where your stop loss currently is, you raise your stop up to that new higher level.
Locking in some gains or reducing risk?
Exactly. Now, if there was a gap open on the day after entry, up or down, you wait the required time, 30 minutes up, 5 minutes down. Then you look at the low of the current day's trading so far.
Today's low after the wait.
Yes. Again, if 6 cents below that low is higher than your current stop, you raise the stop to that level. You keep doing this day after day.
So the stop only ever moves up, never down.
Precisely. It trails the price higher.
What if you identify a setup, put in your order, but it just doesn't trigger that first day?
The master plan gives you some leeway. You can keep the setup on your radar for up to 5 trading days.
And each day?
You reevaluate based on the gapping rules for that specific day, adjusting your potential entry trigger and the corresponding initial stop and target levels if needed.
Okay. And eventually you sell that first half at 7%. How do you manage the second half?
You manage the exit for the second half using exactly the same trailing stop logic. Day by day, you adjust the stop upward 6 cents below the previous day's low, no gap, or the current day's low after waiting for a gap.
Until eventually
the price dips enough to hit that trailing stop and the second half of your position is automatically closed out.
Okay, that covers the long side. Now briefly, the short swing. You said it's the mirror image.
Pretty much. Short selling means betting on the price going down. You borrow shares, sell them, hoping to buy them back cheaper later.
Need a margin account for that.
Definitely. And the setup is usually looking for that pull-up, that small rally within a larger downtrend. The trigger to enter the short sale is often when the price breaks below the previous day's low, signaling the downtrend might be resuming.
And the exit rules are similar, just inverted.
Basically, yes. You'd have a buy limit order to take profit at a certain lower price, and a buy stop order above your entry to limit losses if the price unexpectedly rallies. The guide has a diagram for the short rules too.
And you mentioned some brokers let you place all the orders at once.
Yeah, he notes platforms like interactive brokers allow placing the entry order, sell stop, the protective stop, buy stop, and the profit target, buy limit, all together for short trades.
Okay, underlying all of this is technical analysis. Why does Larry Swing think this works? What are the key tools he focuses on?
Well, the rationale is twofold, really. One, big players, institutions, leave footprints in the market through their volume and price action. Technical analysis tries to read those footprints.
And the second reason?
Market psychology. Fear and greed tend to create repetitive patterns in how crowds react, and those patterns can show up on charts.
So what tools does he highlight? Candlesticks.
Yep, Japanese candlesticks are mentioned. They give that quick visual snapshot: open, high, low, close for a period. The shape and color offer clues about buying or selling pressure.
And volume, of course.
Crucial. High volume can confirm a move, show conviction. He notes it's often high near market tops or at the start of strong trends. Ideally, volume should increase when price moves with the trend.
Higher volume on up legs in an uptrend and down legs in a downtrend.
Exactly. Then there's equilibrium, which is less common.
What's that again?
It combines price range and volume into one box on the chart. Height is the high-low range, width is the volume. The shape of the box gives clues about supply demand. Big, wide boxes, power boxes can signal strong breakouts.
Moving averages seem pretty standard. Which ones does he use?
He focuses on simple moving averages, FMAs, mainly the 10-day, 20-day, and 50-day, based on closing prices. They smooth out price and help define the trend.
Price above rising averages suggests uptrend. Below falling averages suggests downtrend. That kind of thing.
Yeah, that's the basic interpretation, along with the higher high slows or lower high slows pattern.
Okay, then the force index and DMI. Those sound a bit more complex.
The force index combines price change, direction, and volume. He uses a 3-day average for the short-term picture and a 13-day for the bigger trend. He has specific rules for when these cross zero, suggesting potential buy or sell signals within a trend.
And DMI, directional moving index.
That helps gauge trend strength. It has 3 lines, plus DI, DI, and ADX. An ADX reading over 30 suggests a strong trend exists.
And the DI lines.
They show direction. If plus DI is above DI, it suggests uptrend strength. If DI is above plus DI, it suggests downtrend strength.
And that up, down, out thing.
Oh yeah, that's just a color coding system in Swing Tracker for the price bars. Green for up days, red for down, yellow for inside days, blue for outside days. Just a quick visual summary of recent price action.
Gotcha. So Swing Tracker seems pretty central to his approach if you're doing yourself. Besides scanning, what else does it do?
The full platform.
Yeah.
Real-time quotes, obviously.
Mm.
Customizable charts. You can build watch lists that update in real time.
Portfolio tracking too?
Yep, track up to 6 portfolios, set alerts, and it's packed with technical indicators. Bollinger Bands, MCD, RSI, all the usual suspects, plus the ones we discussed like Force Index and DMI.
Drawing tools for
Yeah.
trend lines and stuff?
Drawing tools for marking up charts, plus access to financial news and data. It aims to be an all-in-one tool for his method.
And the guide includes key studies, right? Real trade examples.
It does. Examples like DFXI, PFG, PTEN, they walk through the trade, the date, why the setup looked good based on the technical criteria, linking back to moving averages, force index, etc.
And the results.
Yeah, shows the entry price, stop, target, why the trade was closed, hit target or stopped out, and the profit or loss. They really help make the rules concrete.
Finally, that appendix on short selling. What are the main takeaways there for someone unfamiliar?
It clarifies that shorting is selling borrowed stock. Goal, buy it back lower. Requires a margin account, you sign agreements.
And you're on the hook for dividends.
Yep, responsible for dividends paid while you're short. And you can get margin calls if the price goes up instead of down.
It mentions the uptick rule, too.
Touches on it, yeah. That rule about the last price needing to be higher before you can short, and it covers the reasons people short. Thinking a stock's overvalued or maybe hedging a portfolio against a market drop.
Okay, wow. We've covered a lot of ground there. This deep dive into Larry Swing's guide definitely gives a solid picture of his specific take on swing trading.
It really is a very defined rules-based system he lays out. The master plan provides that structure for finding trades, getting in, getting out.
Absolutely. And like you said, this is the overview. If this approach resonates, Larry Swing offers those resources to go further.
Check out the website, mrswing.com, maybe the email, the Swing Tracker software, or the free stuff in Swing Lab we talked about.
Definitely worth exploring if you're interested.
So that leads us with a final thought to chew on. How does this very structured, disciplined, short-term focused swing trading approach contrast with, say, a more traditional long-term investment strategy?
Yeah, good question. What role could something like this, with its focus on rules and managing risk on shorter time frames, potentially play in how you navigate the markets, especially when things get choppy or uncertain?
Something to think about as you continue exploring different ways to approach the market.